Hey guys, how's it going? Welcome back. In this final video of Unit 3 revision videos, we're going to be looking at Topic 7 and focusing on the impact of recent changes that have occurred within the financial services sector. We're going to be looking at 10 changes in particular, ranging from new financial legislation to the boomerang generation to the 7-day switch guarantee. And for each of these, we're going to be considering the impact that the changes had on the financial services industry and the impact on individuals' personal financial sustainability. So the first one we're going to look at is government-introduced products. Now, the government has introduced a number of products in the financial services sector in recent years. The basic bank accounts has enabled everybody, no matter what their credit rating is, to access basic banking facilities. This has impacted upon financial inclusion rather than financial exclusion. ISAs, individual savings accounts, have given savers a tax-free opportunity to earn interest, one in which they can invest up to £20,000 per year. This has encouraged individuals to actually put money aside for savings. This is one of the government's aims when releasing this account, because they were concerned that individuals were not saving for later on in life. The government has also introduced the Help to Buy scheme, which is a way in which first-time buyers can gain access to the housing market and get on the housing ladder. The second change we're going to have a look at is new financial legislation. Back in 1997, the Bank of England was made independent from the government, and a year later, the Bank of England Act gave the Monetary Policy Committee the power to set bank interest rates in order to control inflation. This means, of course, that the Bank of England's Monetary Policy Committee can set the interest rate what they want in order to control inflation. In recent months, we have seen that the inflation rate has been particularly high, and therefore, of course, this might impact upon individuals' personal financial sustainability because goods and services become that much more expensive. The state pension age has changed over the years. Back in 1950, it was 65 for men and 60 for women. Now, of course, the age at which individuals can access their state pension is 68. This means it has risen over the years, but that said, has it risen enough to counteract the ageing population? People are living that much longer these days, and therefore the amount of time that the state has to pay them a state pension is likely to be longer. This puts pressure on the working population, as a greater amount of their taxes and national insurance will go towards paying for the state pension. There's also been a range of changing consumer protection measures implemented in the financial services sector. The Financial Ombudsman Service, the Prudential Regulation Authority, the Financial Conduct Authority, Competition and Markets Authority, as well as the Financial Services Compensation Scheme. These have all been introduced in order to protect consumers like you and I. Notably, the Financial Services Compensation Scheme ensures that deposits up to £85,000 are returned to individuals in the event that a bank, building society or other financial provider goes bankrupt. The Prudential Regulation Authority tries to reduce risk in the sector by ensuring that financial providers hold enough capital should things go wrong and they have to bail themselves out. The fifth change we're going to be looking at is fluctuating interest rates. We can see from this graph that the interest rate has rapidly increased over the last year or so. It now stands at 5.25%, and as it is so high, this will significantly impact especially those people who have significant borrowing. With significant borrowing, it means that people with borrowing will have to pay a greater proportion of their income each month to servicing this debt. This might reduce an individual's level of personal financial sustainability as a greater proportion of their income goes to service this debt. In fact, the level of their income has to increase in order to cover the level of their expenditure. This might mean that individuals might seek pay rises from their employer, they might seek to do overtime, or take on a second job in order to cover these rising and spiralling costs. The sixth change we're going to look at is the boomerang generation. This essentially means that more people are living with parents for a longer period before moving out and buying a home or living in a rented accommodation themselves. Whilst this may put a greater level of pressure on parents to look after children for longer, it is also reflective of the housing costs we have in this country. The fact is the price of a house compared to the average salary is significantly higher when compared to 50-60 years ago. The seventh change we're going to look at is the affordability of homes. Rental prices have significantly increased, much more so in recent months as the interest rates have gone up. Of course, landlords having to service their own debts. If their own debts and interest payments are going up, then of course it's highly likely that they'll pass those costs on to their tenants, which means that rental prices have gone up. This means that people in rented accommodation are less potentially able to raise enough to buy a house themselves. In terms of earnings in real terms, earnings have gone down because of the significant inflation. This, as I mentioned earlier, might push people to request pay rises from their employer. They might also be in the position where they might wish to take on overtime or a second job in order to increase their incomes. What has happened to first-time buyer deposit levels? Well, lenders, because they are less willing to lend to people without an established credit history, might have increased the level upon which first-time buyers need to have in terms of the deposit. That said, the Help to Buy scheme introduced by the government has certainly helped first-time buyers in this respect. Information and advice has become significantly easier to access. It's also been available much widely because of the internet. It's become easier to understand, and it offers comparability between different services, especially on price comparison websites. There is reduced fees for information and advice, whereas many years ago you might have chosen to go to a personal financial advisor. Much of the information is available online these days. So the impact of the above is actually very positive on an individual's personal financial sustainability. That information and advice can be used to purchase the correct and right products for themselves, whilst also avoiding those with higher interest rates. Price comparison websites, for example, can be easily used at the touch of a button to be able to find the best mortgage interest rates and the highest saving rates, for example. The 7-day switch guarantee, which has been introduced in the financial sector, is also a great opportunity for customers to switch easily and conveniently between financial products. More competitors entering the market has led to a greater choice for consumers, and the 7-day switch guarantee allows them to switch accounts especially quickly. On day 1, the customer agrees the switch date with their new provider. On days 2 to 6, the new provider begins transferring payments from their old provider. The customer can still use the old account. And on day 7, the old account is closed and the funds are transferred to the new account. This has been particularly beneficial for new challenger banks such as Monzo and Starling, who might be attractive to people with their high interest rates on savings and lower costs of borrowing. They can afford to charge a lower cost of borrowing, of course, because they're internet-only banks and therefore do not have high overheads like a traditional high street bank. The impact of technology has also had a huge influence upon individuals' personal financial sustainability as well as the financial services industry as a whole. We can see from this table that the number of people accessing the internet is 21 million households. This is 83% of all households in the United Kingdom, up from 65% in 2008. People who access the internet every day include 36 million adults, 73% of all adults, up from just 49% in 2008. Those who have bought goods or services online, those who have accessed the internet using a mobile phone, and those who have accessed their bank account over the internet has also increased rapidly. This means that people are able to check their bank account balances and check on their financial information much quicker and much easier than before this technology allowed it to do so. This means that they could potentially avoid getting into unmanageable debt if they could access their information easier and therefore keep a tab on what their spending was. That said, it would also impact upon the financial services industry. Having and developing these products for consumers might impact upon their cost base, and therefore they might have to push on these costs to the consumer in the form of higher borrowing rates or lower savings rates. As not all adults, however, have gained internet access, the trend of growing online financial services is increasing potential financial exclusion. We mentioned earlier that the potential to switch easily to these challenger banks, which are online only, is growing. But of course, if one does not have access to the internet, then there will be the growing financial exclusion because so many services are going online. However, as many financial services migrate online, this means that those who do not have internet access might be excluded from certain financial services. It would be wise, therefore, for certain financial providers to offer guidance in order for individuals to access these financial services online, and in fact many providers are offering guidance and expertise to these individuals about how better to access online services. There's also the growing debate over whether financial services providers should close high street branches. There is a number that have chosen to close a significant number of branches in order to avoid the costly overheads, whilst some financial providers also have chosen to keep their branches open as a unique selling point compared to those who are closing so many of their branches. The impact of technology, of course, has also offered other opportunities for financial services customers. Bitcoin has been an emerging opportunity for some financial services customers to invest. However, we have to remember that investing in Bitcoin is an opportunity that might see our net worth grow, but also might see our investment decline. Make sure you smash that like button and subscribe to the channel in order to be notified of when future videos are released. I'll be releasing model answer videos as well as case study review videos in the coming months. You may also wish to click on the link to the multiple choice question preparation video. It goes through over 100 multiple choice questions and provides fantastic preparation for your upcoming multiple choice exam.